Hello everyone, this is Andrew McNair from SWAN Capital with our May 2023 SWAN Report. In this month's video, we're going to discuss some recent headlines that have influenced the financial markets, but I want to provide you some perspective on what these developments may mean for you and your family's portfolio over the next few months ahead. Now, as always, please stay tuned at the end of this video for some required disclosure statements. At SWAN Capital, our market outlook is actually optimistic, and that may be a big surprise for you. Right now, consumer sentiment is the lowest it's ever been since the tracking of consumer sentiment since the 1970s by the University of Michigan. People are negative right now, and it is our job to be a voice of reason to you. Our optimism may be illy placed, but we believe there's a lot of things, both positive and negative, that we're keeping our eyes on. But it doesn't mean we have to be negative, because we don't want to be cynical when it comes to investing. We will navigate these choppy waters as the tides and the currents continue to change, and they always change. It's never as bad as it seems, and it's never as good as it seems. One of the reasons consumer sentiment is as low as it is because of the debt ceiling. As talks come down to the wire again, the debt ceiling limit debate continues to loom over the markets and the economy. You can barely turn around in May without hearing all the dire predictions from all these news outlets of what could happen if we don't raise the debt ceiling and the catastrophic results of a potential default. All the while, we're all frustrated that we actually pay these politicians that they can't balance the budget and they can barely raise the credit limit on the credit card. But both parties signed that the default isn't on the table and a deal will be reached, which calmed the markets somewhat as the month wore on. Simply put, there is a limit on the amount of debt that the government can issue. And since the government spends an ever-increasing amount of money over time, the ceiling needs to be raised periodically so that the prior commitments can be met. We do have a spending problem. Can you imagine going back to your credit card company asking for an increase in credit, but when they ask you, do you have an increase in income? You say, no, I'm poorer for it. They would not give you a credit limit. Whether you agree on whether the government is spending its funds on or how much they should be spending, we are still in limbo right now because of Congress and President Biden seemingly haven't felt pressure to fix the problem until markets really seem to freak out. And that's probably why election year, they will probably get it figured out because they don't want to get fired. And that hasn't happened yet, even though we're in this limbo period. We believe, and the market believes, that our elected officials aren't dumb enough to default on the government's debt. The fact is we have gone from no compromise on either side to possibly getting a workable deal soon. Ironically, in this situation, demand for U.S. Treasury bonds actually is going up while prices are rallying and interest rates decline. These are the same bonds that will not be paid if the government defaults. In times of uncertainty, U.S. bonds are considered a safe haven, so much so that even with the uncertainty stemming from the possibility of them defaulting, we may still be on the brink of a default, and any slight miscalculation could potentially blow up in all of our faces. We waited this long to address the problem, but market volatility has seemed to be benign so far. Bond yields have only begun to tick up in the past month as markets grow more nervous. If the debt ceiling is raised in time, we will likely quickly forget about it until next time. If something crazy does happen, though, stock prices could drop and bond yields could then spike. And that would be a cocktail that we don't want to see for the economy. That is not what we need during this recovery. Believe it or not, though, the markets think we may be in store for more rate cuts later on in this year. And actually, it's probably the complete opposite. I think we're going to see a pause, maybe one slight more increase. But after the Fed has nearly broke the housing market, nearly broke the banking sector, it appears the Fed has been a little frightened to the point where its desire to slow employment, and therefore the economy, may have gone just out of reach. The Consumer Price Index, CPI, has declined from 9% last June to 4.9% in April, and regular gas is hovering at $3.60 a gallon nationally. So inflation has declined, but it's nowhere where the Fed would like to see inflation. But if the Fed continues rate hikes, it would appear to be just plain mean and piling onto an economy with an already faint pulse. Jobs and consumer spending appear to have helped keep this economy limping along, but with rate hikes much higher than they are a year ago and consumer debt piling up, an effort to crush job growth would have significant ripple effects on an already weakened economy. So we don't foresee the Fed making any large rate increases, but maybe one slight increase. And I would like to see personally then just put it on pause to let the economy, take a breather as these interest rates make its way through the economy. As we hopefully near a debt ceiling deal and put that conversation behind us, the markets will likely focus once more on the Fed and what it will or will not do in June and the rest of the year. It will be hard for the Fed to justify any additional rate increases in the face of current economic weakness and remain higher for longer by resisting the pressure to lower rates and try to improve the economy ahead of an election year. Just like it takes time for rate increases to work, it also takes time for rate decreases to work their way through the economy. And we don't want to see these rate hikes and rate decreases like a seesaw. It is not good for the economy over the long haul. That process of lowering interest rates might be faster, but in order to make a difference by election day, the process would need to start earlier and to be really truly felt throughout the economy. The pressure on the Fed to lower rates sooner than it would will be acute. And that could really help equities later in the year. But again, my personal opinion is I don't want to see any rate cuts. I do think that interest rates where they are is a healthy interest rate today, even though we're comparing it to historically very low interest rates that should have never happened 3 years ago. In other news, the FDIC said that it plans to charge the country's top banks $15.8 billion in additional fees over the next 2 years in an attempt to replenish the deposit insurance fund following these recent bank crashes. Now, each bank will pay a specified amount based on a special assessment of which banks benefited the most from the coverage of uninsured depositors. Now, meanwhile, lending officers at major banks said that they have tightened standards in response to the banking failures, which is great news. That's what we should have learned from 2008. They also reported reduced demands for loans in the first quarter, probably due to both skittish borrowers and the higher cost of borrowing money. So why are we optimistic? Always remember that there are good things happening underneath our feet, even if we're not paying attention to them, such as innovation. Things are happening, positive and maybe negative, with AI and robotics and 3D printing that are going to change our economy over the next decade. There are population growths in certain pockets of the world. That's going to help. We always need to stay optimistic, and that's why markets continually go higher over decade after decade. So we just have to remain patient. And that's all we have for this market recap for the month of May 2023. If you have questions about your own portfolio, you have concerns about your retirement, give us a call so we can have a one-on-one conversation about your certain situation. All you have to do is call 1-800-848-8768. That's 1-800-848-8768. Talk to you soon.